and also bring on board Mayuresh Joshi from Angel Broking. Mayuresh, still trying to digest the earnings really from Dr. Reddys, and while there is a one-time provision that they've undertaken, or hit rather, on account of the Venezuelan operations, the India as well as the Russia business too have disappointed. What's been your takeaway from DRL?
Afternoon, Aisha. I think prima facie the numbers are a little bit on the softer side as per our estimates. But going forward, I think the entire Venezuelan hit would largely be recognized, in my opinion. And what the markets were really expecting is the outstanding sales of $60 million from Venezuela was going to create an impact both on the EBITDA and the bottom line. Having said that, probably I think the US sales are also facing issues related to supply disruptions at its Duvada plant. And what really comes out of the remedial issues, both at Srikakulam and Duvada, is going to be extremely critical from an FY18 perspective. The markets have largely digested the fact that FY17, the remedial costs as well as the remediation issues are going to take a while. And again, I think the strong NDA pipeline holds Dr. Reddys in good stead. So the biosimilars business that Dr. Reddys is pursuing at this point of time, and the kind of R&D expenses associated with the same and expected to remain at elevated levels between 11 and 12%, will probably keep EBITDA margins in check between 23 and 25%. But largely, I think the numbers are a little bit soft as per our estimates. But again, I think it really depends on the management commentary in terms of 2-3 key issues. A, about the remedial and the remedial issues related to the Duvada plant, the supply disruptions thereafter as well. What happens with the generic pipeline in terms of approvals coming through the next few months and quarters. And fourth, I think the general business outlook, both in terms of the India business, along with the UCB acquisition that they have done, and what happens with the rest of the world, considering the currency devaluation that we've seen, that impacted both the EBITDA and the bottom line. So I think these factors will be watched out for, but valuations, in my opinion, remain attractive from a large cap perspective. But the stock might consolidate around these levels unless I think we receive further clarity on all these issues.
Okay, and other than that, what exactly have you made of the earnings season gone by? In terms of the banking space in particular, how have you assessed the numbers?
Afternoon, Navan. Again, on the retail private-oriented space, the numbers have been quite encouraging. So if you look at numbers of IndusInd, yes, Kotak yesterday came with a very impressive set of numbers, in my opinion. The growth there looks very, very reasonable, with retail yielding a majority part of the gains in terms of how the earnings growth will look for these banks, with retail accounting for a major part of the accruals that the bank will probably look forward to. The advances and the deposit growth should be quite robust. The asset quality should hold up for them because the exposure specifically on the corporate and the SME book is quite less for these banks. However, valuation is a little bit too stretched. So again, in my opinion, I think investors holding on to the stock should continue holding on. HDFC Bank is something that I am really liking even from this point of time. And again, I think the kind of earnings growth that one really expects for 21-22% should hold it in good stead. Similarly, I think with the bankruptcy law getting passed, I think the long-term positive and synergies would be seen in a lot of banks which have a corporate and SME exposure. You're probably seeing that moment happening on stocks like ICICI and Axis. But again, if one goes by the management transcripts on the kind of asset quality pressures that they probably are expecting to come through in FY17, and if one really assumes that on both counts credit growth does not pick up meaningfully, and B, I think the working capital constraint on the end user industries still remain, the stocks still look very, very attractive from an FY18 perspective, assuming that the cyclicality will change for both these factors going forward, and that will entail earnings growth in excess of 20% for both these banks as well. With quality pressures coming down on the asset book, you're probably looking at decent capital adequacy for both these banks, which ensures balance sheet expansion. So the private space is what we're liking at this point of time, retail. But again, if one has a long-term horizon of more than a year, year and a half to say the least, even banks like Axis Bank, ICICI Bank should perform relatively better over FY18.
Fair point. Mayuresh, what's been your observation as far as earnings go, and especially some of these consumption companies, be it FMCG or for that matter, some of the paint companies? We saw Asian Paints deliver actually a good amount of volume growth just yesterday, be it Dabur or Marico. Their volume growth has been quite impressive. Would you say this is something out of the ordinary? This is not something that the street was actually expecting?
No, again, actually, you need to look into the FMCG stroke consumer stocks in a very holistic manner. What has probably happened in terms of volume growth has also been a mix in terms of pricing cuts being taken and the price deflation that we've seen in terms of how key products have moved. Secondly, I think the input cost deflation has probably abetted the EBITDA margins to a great extent. But will this continue over the next couple of years is a question one really needs to ask. So if one really assumes that commodity prices start on the upswing again, you might have some compression happening on the EBITDA front. But again, I think if monsoons are better, if the pay commission recommendations start coming through, the rural discretionary spending will come through, which is paramount for a lot of FMCG companies to drive their volumes. What this effectively also does is that the realizations also improve and the discounting factor slowly and steadily starts receding away. Yes, there is competition, and that has been very, very evident in terms of how the A&P spends have been for a whole host of companies. That might continue, but the pie is pretty too large, both in terms of the core products that a whole host of these companies are doing. So in my opinion, again, I think Asian Paints a very impressive set of numbers. The price cuts that we've seen specifically in the decorative paint segment that they've undertaken would entail that the volume growths maintain and get maintained in those double-digit numbers. And again, I think in terms of repainting demand expected to come through with good monsoon, specifically on the rural side, tier 3, tier 4 cities, would help the company in a big way. Home improvement probably has not done that well because it's still a capital-intensive business. They're still pumping money into that. The overseas business has probably held up, but the adhesive business that they're entering into is going to be a very, very key proposition for Asian Paints. Valuation, however, on the higher side, but one really needs to be stock specific. So what I really like is something like a Dabur, where volume growth has been exceptional. Investors can continue holding on to Britannia, and stocks like Asian Paint.
Fair point. Good chatting with you, Mayuresh. Thanks much for taking the time out and speaking with us today.
Thank you so much.
Okay, let's take a very quick break then. When we come back, we'll chat personal finance and we'll try and figure out if the bankruptcy bill actually